Strategy A. Stable core. This strategy is for people who value sleep more than excitement. The stable core focuses on capital preservation and peace of mind. The goal is not to win every year, but to stay in the game through all market cycles. The backbone is a mix of bonds and equities, providing income and long-term growth. Gold plays a small but important role, as insurance when uncertainty rises. Bitcoin, if included at all, remains a minor long-term option. Not a conviction bet, but a carefully sized exposure to potential technological upside. Strategy B. Barbell. Here, caution and ambition coexist. The barbell strategy combines a conservative core with bold growth exposure. Gold provides stability on one side of the barbell. Bitcoin sits on the other, offering a symmetric upside with the understanding that volatility is part of the deal. The key element is discipline. Predefined rules: when to add, when to trim, keep emotions from taking control during market euphoria or panic. Strategy C. Robust mobility. This strategy is not about returns, it's about access. Robust mobility is designed for unstable or high-risk environments where systems may fail or borders may suddenly matter. Physical gold acts as an offline emergency asset, recognizable, liquid, and independent of technology. Bitcoin provides mobility. It allows value to move across borders quickly, without banks, and without relying on local financial infrastructure. This strategy isn't theoretical, it's built for the real world when flexibility becomes survival. Real life, Cyprus, 2013. Cyprus 2013 was the moment many people learned that money in the bank is not always your money. Overnight, bank deposits were taxed. Savings that families had built for years were suddenly locked and partially confiscated by emergency rules. Some people turned to gold, using coins for direct payments when the banking system froze. No terminals, no approvals, just trust and immediate exchange. At the same time, Bitcoin enabled rent payments from abroad. Funds sent digitally crossed borders when banks couldn't, keeping daily life moving while the system stood still. Real life, Venezuela and India. In long-running crises, survival becomes more important than ideology. In Venezuela, crypto enables remittances under strict capital controls. Traditional transfers are slow, expensive, or blocked, while digital assets move faster and more reliably. In India, gold jewelry acts as social and financial capital. When times are good, it represents tradition and honor. When times are hard, it becomes working capital, melted, sold, or pledged to keep businesses alive. In moments like these, theory doesn't matter. What works, works. Real life, Ukraine 2022. War compresses financial decisions into hours, sometimes minutes. In 2022, banks were closed and payment cards stopped working across borders. Access, not yield, became the priority. People exchanged gold for cash and transport, a bus ticket, a meal, a safe place to sleep. At the same time, crypto was used for donations and aid. Funds reached people directly, quickly, and without bureaucracy. When traditional channels failed, not perfect, but enough. Common mistakes. Most people don't fail because markets are unfair. They fail because they make the same mistakes again and again. The first mistake is going all in on a single asset. History is clear. Concentration feels smart in good times and brutal in bad ones. The second is buying at euphoric market tops. Both gold and Bitcoin move in cycles. Chasing headlines usually means buying excitement, not value. And the third mistake is ignoring custody and counterparty risk. An asset you can't access when you need it is not a safe asset. It's a promise. Operational risks. Risk doesn't always come from price. Often it comes from operations. With gold, the risk can be counterfeits or unreliable dealers. Saving a small fee can lead to the most expensive lesson of all. With crypto, history is full of exchange and custodian failures. Assets disappeared not because prices fell, but because intermediaries collapsed. And many investors forget taxes and regulation. Rules differ by country, and crypto adds reporting obligations. Ignoring this can turn profits into problems. What safe means depends. There is no universal definition of safety. It depends on who you are. For a retiree, safety means calm, predictable cash flows and low volatility. Gold might play a small role, Bitcoin often none, or very little. A young saver thinks in decades. Growth matters and volatility is acceptable. Equities and some Bitcoin make sense, with gold as a counterweight. An entrepreneur thinks operationally. How fast can I access funds? How flexible is my capital? Gold for offline scenarios, Bitcoin for mobility, and cash to pay Monday's invoices. Final summary. So what's the takeaway? Gold is the analog foundation. It offers no yield, makes no promises, and owes nothing to anyone. Bitcoin is a digital option. It can succeed spectacularly or fail painfully. That's why position size matters. This was never about either or. It's about how much and why. And in the end, one rule applies to both. Good custody is half the result.